alliance management, it is integration and cooperation, and learning part. How do both the partners they learn from each other or from the alliance, and global multilateral alliances. We stopped at the rationale for cross-border mergers and acquisitions. Now here, the cross-border acquisitions performance. Now, how is the performance of these companies once they undertake a merger or the acquisitions that we will be discussing today. Now here, the success or the failure in between these companies, it depends upon the quality of pre-acquisition process and post-acquisition process. Pre-acquisition process, the before part, before acquisition, and post-acquisition process is after the acquisition. What is the scenario? Now here in this first phase, the pre-acquisition process, it's how companies make the merger and acquisition decision, give it a value, and negotiate the deal. How they do that? And the quality of the post-acquisition process, how the integration is managed. Now this is about the implementation part. How it is implemented. First is the part of the decision making, that is the pre-acquisition process, and the post-acquisition process is with reference to implementation of this, or you can say the action plans of the decision making. Now this post-acquisition, this process is considered the most important source of success or failure. So here uh, the companies, they understand whether their decision was proper or not. Now if you see, let's have a look at this pre-acquisition process. What all is involved in this pre-acquisition process? Now here, basically justifying the economic rationale of the acquisition. When we say that it is the company is a success or failure, so it is reflected maybe in terms of revenues, maybe in terms of market share, the reflection in the market share, the share value of the companies, whether they increase, they decrease, shareholders, what is the role of the shareholders here. That is what is important here. Now, first and foremost thing here is the value creation part in this pre-acquisition process. That is, how do the companies take into consideration the value creation? Now, basically, the mergers and acquisitions contribute to improvement or enhancement of the economic value of the companies involved. Now, how do you calculate these economics of mergers and acquisitions? It's very simple. A merger or an acquisition is justified if and only if the value of the new merged company or combined company is larger than the sum of the value of the independent entities prior to the merger. Then from strategic point of view, mergers and acquisitions can create uh, following types of values like consolidation of companies, global reach, vertical integration, diversification, options or acquisition. When you think in terms of this value creation, the consolidation of companies operating in the same business area, that is, we are speaking of horizontal business area, it is taken into consideration. That is consolidation. Now, global reach, that is the extension to the international markets. Maybe how the companies have reached globally through the extension of the integration. The next is vertical integration, where merging of businesses which are suppliers or buyers of each other's products. So, like Frankeler or Toyo Inc. possibly belongs to this category. Similarly, diversification. Many companies operating in different business domains, they come together, like the Sony Columbia deal. Options or acquisition of a firm in a new technology or market to monitor its evolution. So, international these mergers and acquisitions, they usually belong to first or second type, but because of globalization and changes in the economy, changes in the new economy, that is, I'm speaking of digital revolution, it has triggered to the development of diversification and the last option of options and acquisitions. Now, when you take into consideration the value, it is created through two modalities. One is the short term of value, and the second one is long term strategic value. Now, what is this short term of value? Short term value comes from the one of post merger realization of cash benefits coming from a tax shield, asset disposals, and immediate cost savings or debt leverage. And long term values come from the competitive advantage gained from the merger. Either it provides enhanced differentiation capabilities, maybe a large market, new growth opportunities, enhanced competencies, or cost advantage through economies of scale or scope. Now, these advantages are often referred as the synergistic effects of a merger, that is, post merger effects. Now, when we speak of this short term value creation, the tax shield is one of the important thing here. The asset disposals, the financial engineering like debt leverage and price earnings ratio leverage is taken into consideration. If you take into consideration the tax shield, the diminution of tax bill or the cost benefits is the advantage. When we say take into consideration the asset disposals, it's the lower capital invested, higher return on the lower cost invested. The total market value is increased after the merger as far as the price earnings ratio is considered. A positive market reaction is considered. So this becomes beneficial or advantageous for the companies in case of merger or acquisition. Long-term value creation, that is pooling and sharing of resources. Since both the companies they come together, they take into consideration the aspects of joint purchasing, manufacturing rationalization, sharing of technology, joint distribution and logistics, common IT platforms and centralized services, common treasury. So when you share the resources among the companies, so naturally it will give you the economies of the scale and the scope, that is it is going to benefit you cost wise. Similarly, enlarge markets, that is the geographical boundaries, the growth potential of the market is enhanced, the products, that is a richer value proposition is there, there is high reach and possibly higher differentiation. So as two companies they merge, or a company in case of acquisition is able to enlarge the market size. Similarly, there is transfer of competencies also, like technology and best practices. It gives scope to higher differentiation. The processes becomes more effective, and there is innovation, that is higher differentiation and a lower cost, which play a major role in value creation. Now, this is one of the important part, that is uh, it, the value creation gains a edge over the competitors. Now, the next part is due diligence and valuation. Now, due diligence and valuations, they are the main handicaps to global acquisitions, particularly in emerging markets. Now, there are three reasons for this. The first one is marketing and strategic information. They are often less accurate and reliable, or at least less accessible than in the home country of the buyer. Hello. So, what is the meaning of this due diligence? Basically, that is whether the things are moving properly in case of the merger or the acquisition. That is what it means. Now, the second one is the political or nationalistic attitude, which may hamper the fair assessment. Maybe we enter into a merger or acquisition, and further moving ahead, maybe the political or on the national upfront, there may be some issues which may hamper the merger or the acquisition. And third is the accounting standards. Accounting standards are not necessarily in line with international standards. Now, in Korea, for instance, tribals do not usually consolidate their accounts and do not eliminate intercompany transactions within the same groups. Now, this can lead to inflated revenues. Similarly, in Southeast Asia, accounting ledgers are kept for tax purposes, and the figures have very little relevance for asset valuation. So the major adjustments have to be made here in this case in accounting. Like inventories, they may be overvalued. The employees' retirement benefits may not appear or may be underfunded, and provisions have to be made for future liabilities. In certain cases, the accruals are ignored and have to be restated. The real estate has to be valued at market prices and necessary tax adjustments have to be made. So here, as far as accounting standards are considered, some of the adjustments are most frequent. Now, in case of acquisition of a company that is a part of a corporate, adjustments for any cross-border subsidiaries transfers which may have distorted announced profitability may have to be made, and checks are to be kept as to whether any license, distributors, or contractual agreements are still in place after acquisition. If such contractual assessments are originally been granted to the parent company or the mother company, adequate transfers have to be included in acquisition agreements. Now here it requires more time and effort to validate data than normal in this case. One has to validate the data, whatever information they are getting. Now coming on to the economic valuation, there are three methods in it. Economic valuation is necessary in order for the potential buyer to decide at what price it is willing to conclude the deal or close the deal. Or in case of a merger, the relative proportions of shares are to be exchanged. Now, there are three methods, that is asset based valuation, market based valuation, and cash flow based valuation. If we take this first into consideration, that is the asset based valuation, this method determines the actual value of assets minus liabilities using a replacement price for physical assets and adjusting for inventories or debitors book value. Now, intangible assets and goodwill are estimated using comparable value for similar businesses or using formulas such as dollars per customer. The market-based valuation, this approach relies on direct market value if the company is listed on stock exchange or otherwise on stock market equivalent valuation. When using stock exchange market value, the transaction will require that the bidder puts a premium on the deal. Premiums are based on the anticipation of value added from the merger. So when the companies merge, whether there is any improvement in the market valuation as far as the stock exchanges are considered is of prime importance. Now the next part is the cash flow based valuation. Economic theory would say that only valid method apart from the actual market price put on the stock market when the market is efficient. Now with this method, the value of a firm's equity is equal to the net present value of future cash flows discounted with the weighted average cost of capital minus debts. So in practice, this method implies a calculation of future cash flows. So it takes into consideration what would be the future cash flows. Now, for this, if you have seen, there is a matrix. Maybe we will be going to study later. So through that, they come to know about the cash flows from where they are getting. In order to calculate future cash flows, one is forced to forecast revenues based on demand, price, and market share assumptions as well as costs over a period that reflects a sound strategic horizon. Now, the future cash flows of the merging or the acquired company is calculated as if the company continues its activity without merger. This is the standalone value. Normally, if the company is listed on the stock market, its market capitalization should reflect its standalone value. Otherwise, forecasting and discounting are needed here. The future value of the added value bought in short term and long term by the merger of two companies. Now, this is the synergies value we say. Now, these two streams of cash flow give a present value that reflects the bargaining range of the price negotiation. Below the standalone value, no seller would sell unless a fine sale or because of extreme non-economic pressures. Then only they can think of it. Now, if we take the integration of these companies, the phases, there are three phases: the integration framework, the transition management, and the strategic consolidation. Now, if we take the integration phase. The integration phase starts once the deal have been negotiated and the acquisition or the merger decided. Now, most of the scholars or researchers consider this phase of merger and acquisition as of relevance, or you can say it's the important stage and major source of failures. When not handled properly, they may turn as a failure. This becomes the main source when you do not take this into considerations. So one has to take care of this step. They may lead to value destruction instead of value creation many a times. So this integration process has to be put into place properly or accurately to get the things done. Now, the first is the integration framework. Now, integrated framework is needed as a roadmap for implementing a merger. Since after integration, or one can say Post-merger phase is a period of intense anxiety and uncertainty for the employees, the suppliers, the distributors of the company. Now here when the news comes of two companies being merged or one company acquiring the other company, there are many uncertainties in the society. Now here the employees, they are concerned, the suppliers are concerned, the shareholders are concerned, because nobody knows what will be the reflection of this merger or acquisition down the line in future. What would happen to the share value of the company? So it is important that the framework guides the management process. Various frameworks have been offered by consultants. They can be classified into the linear framework and contingent framework. Now, when we take into consideration the failure in the integration process, the failure may be due to strategic lack of strategic decision. Here, the actions and decisions are not understood properly. Okay, when we speak of two companies coming together to merger or acquisition, there is resistance to change from the employees, resistance to change to get adjusted to the new systems, adapt to the new processes. So here there is uncertainty. Similarly, lack of integration plan, improvisation, time lost, anxiety is there. There is lack of quick response to events. There is the leadership vacuum. There are political reasons, bureaucratic hassles, which has to be taken into consideration. There may be a lack of communication. There may be some fears. If we take into consideration the cultural aspects, there may be the stereotype clashes like we had seen. There may be stereotype people, those who already have the preconceived notion about the cultural background or the management from the employee side. They may take more time to adjust. Lack of operational focus or no quick wins. Let go approach are many a times lacunas here. Loss of key management talent. That is, you may have a less productive workforce. One company would be very much efficient as far as the technology part is considered, as well as the well trained and skilled human resource, while at the other end you may find the other company which is on a very lower scale as far as this part is considered. Wrong synergies may be there, that is loss of efficiency, or they may be dysfunctional operations. So there is no motivation or there is no required leadership skills after the merger. So as far as the leadership also considered, handling of the issues properly, choosing a new leader, the leader treating the team as a one team from the both the companies. So these are some of the parts which may lead to failure if not handled properly in the integration framework part. Now let us come to linear framework. Linear frameworks that are step-by-step or checklist approaches to integration that apply to all mergers and acquisitions, and contingent frameworks that differentiate integration processes according to environmental and strategic actions. So here when we take into consideration these linear frameworks, it's a one-to-one or checklist approach to integration. And contingent framework, these are integration process with reference to environmental and strategic action. Now here in this contingent framework, three modes of integration are stated. They are the operational interdependencies and the degree of required organizational autonomy. So when we take into consideration contingent framework, the degree of required operational interdependencies between the two companies that are needed to achieve synergies, for instance, the rationalization of manufacturing or transfer of competencies between companies, the degree of required organizational autonomy that the required acquired company would need because of the difference in the market and environment conditions with the acquirer. Now, for instance, an acquisition in a different business or a country that comes into this. Now, the three integration modes, the next part is, are the preservation mode of integration, absorption mode of integration, and the symbiotic mode of integration. The preservation mode fits with situations in which few operational synergies can be gained, and the business context call for large autonomy of decision making, as in case of diversification or option acquisitions. Now here, since no benefits or interdependencies are to be expected and no major value can be brought in by forcing integration of processes, assets, and decision making. The key objective is first to preserve the identity and autonomy of the acquired company, keeping in place as far as possible the existing management and learning progressively the rules of the game of the businesses. The source of value here essentially comes from an enlargement of markets and products as well as from the transfer of resources or new competencies. Now, in this mode, one should not try to expedite the transfer of new competencies unless one has understood their logic and their impact on the organization and culture of the other company, that is the recipient company. Now, coming to the next is the absorption mode of integration. Now, absorption mode of acquisition takes place when value is to be expected from the realization of operational synergies in companies operating in similar business context. Now, here the objective is to achieve the necessary consolidation and rationalization as quickly as possible. Since the businesses are very similar, the top management of the acquirer or the top management of the merging firms are competent rapidly to find sources of savings and understand which best practices have to be adopted. Now, this rationalization may arise from some practical difficulties in case of equal mergers when duplicated functions have to be eliminated. If both the companies have the same functions, then there will be duplication and hence it has to be uh, eliminated. Now, here the ultimate objective is to switch or to see to it that they apply the motto or that we are one company. If they have common culture, then it becomes much more easier. So coming together and having that feeling that we are a one company now helps in imbibing very quickly a common culture in the organization. The symbiotic mode of acquisitions tries to achieve a balance between interdependencies and autonomy. This is often the case in cross border horizontal acquisitions, where a lot of value is gained from the achievement of synergies. But the differences in the context requires a high degree of autonomy. Now, in this mode, the starting point is to use the preservation model and to find jointly the real resources of synergies and their practicalities. So, this is about the integration framework part. Now, integrating the companies, the transition phase. Now, this is the transition phase. Now, whatever the mode of integration is, there is a critical phase in any merger and acquisition. This is known as transition phase. Just after the merger or an acquisition, the various stakeholders of the acquired or merged firms are in a state of shock, or at least, there is some uncertainty, and the operations may suffer from these uncertainties surrounding the pre acquisition phase. Now, there are main issues to be solved at this stage in this transition phase. Now, first and foremost is the appointment of an executive team and interface management. Now, here the critical issue is to install a management team that is capable of understanding the cultures in between both the parties or both the companies, and making them come together and form a new culture. So this is very challenging task for the management, and they have to appoint a executive team for this. Most of the time, the change will be demonstrated by a new logo that may or may not combine the two names of the founding companies. Now, in acquisition, the critical issue is to trade off the need to control, and the need to preserve the key contracts and knowledge of the previous management team. There is also the need to make sure that the appointed management team will be efficient to take care and handle the indiscrepancies as far as the cultural part or adjustment of employees is considered here. Now, new sense of purpose. Now, there could be anxiety or there could be resistance, which can be best achieved if the new management communicates the goals to be achieved, to make the others understand what is the purpose of this merger or integration. Basically, the shareholders, that the merger or the acquisition was well planned, it has to be assured. A reassurance has to be given to the all the stakeholders of the company. It has to be communicated properly and in a systematic way. The next is operational focus. Focusing the attention on concrete operational details and performance targets has two major advantages here. First, it is likely to help in removing the uncertainty created by this merger or acquisition. And the second is it will help to give people a tangible sense of participation in the integration process. It helps to develop mutual understanding among the employees of both the buyer and the seller organization. The next is mutual understanding and respect. So, basic thing is in this merger or acquisition, it is uh, the cross-cultural issues which are likely to arise in case especially of the cross-border mergers. The ability of the two entities to understand each other is critical for success of any organization. The basic objective at this transition phase is not so much to merge the two cultures as to create a climate of mutual understanding. Both the companies should have mutual respect for the culture, the procedures, the pros and cons, measurement and control. Now, when we take into consideration the communication facts, it allows a measure of improvement and reduces the risk of cultural excuses. The cultural excuses are used in the event of difficulties or disagreements or conflicts based on impersonal or stereotyping judgments. The collection of marketing, operational, and financial hard facts and figures is necessary condition for an efficient and productive dialogue.
Ma'am, can you please unmute your mic?
Hello. Okay. Hello.
Yeah, now it's audible.
Hello.
Hello.
Okay. Whether you understood these 8 key points. Hello. Now, these 8 points in the transition phase will lead you to the final integration phase. One can say that if these 8 points are taken into consideration, it will lead to a proper merger, or we can say the acquisition. What purpose or intention the companies had come together, that will serve the purpose. Otherwise, we will see that it would be a failure. Now, there should be fair processes to gain the loyalty and commitment of the managers of the acquired companies. Fair process is a management practice used on combining those integration principles advantageous to achieving both efficiency and local entrepreneurship. So here, to maintain the goodwill, the acquirer has to take a step back. It cannot impose all the things on the acquired companies at a single set or a single go. It has to go stepwise, step by step procedure it has to follow. So this was the last phase. We will continue the rest part in tomorrow's session. Okay, today we will stop here.